Good afternoon, everyone. Welcome to the bank's quarterly inflation report press conference.
Since the referendum was called, UK households, businesses, and the financial markets have reacted at different speeds and to varying degrees to the prospects for the UK's departure from the EU. Financial markets, particularly sterling, marked down the UK's relative prospects quickly and sharply. Households looked through Brexit-related uncertainties initially, but more recently, as the consequences of sterling's fall have shown up in the shops and squeezed their real incomes, they've cut back on spending, slowing the economy. Businesses have been somewhere in between. But since the referendum, they've invested much less aggressively than usual in response to an otherwise very favorable environment.
You say you take an average of possible arrangements in the future, but for the short-term transition.
The combination of this strong external environment, UK businesses' high rates of profitability, their low cost of capital, and the limited spare capacity in the economy are all expected to support investment by UK firms over the forecast period. However, while on balance these incentives more than offset the drag from continued uncertainties around Brexit, business investment is still likely to grow below historic averages, with adverse consequences for productivity, capacity, and wages.
If you are, how worried are you that that rise in credit, unemployment at 40-year low?
Turning to inflation, CPI inflation fell back to 2.6% in June, in line with our projection in May. The MPC expects inflation to peak around 3% in October and to remain around 2.75% until early next year. Conditional on the market curve, which implies that bank rate will rise by 0.5 percentage point over the next 3 years, inflation is projected to remain a little above target at the end of the forecast period, an overshoot that reflects entirely the effects of the referendum-related fall in sterling.
Arrangement. Is that because there's less clarity about the transitional period than there was 3 months ago?
As the Brexit negotiations proceed, the assumption of a smooth transition to a new economic relationship with the EU will be tested. If UK households and businesses look through the flurry of headlines, then the economy can be expected to pick up from its current period of sluggishness. Given the outlook for supply in the economy, even a limited pickup in growth is likely to have consequences for the stance of monetary policy. That's because, as the MPC has previously emphasized, the process of leaving the European Union is beginning to affect potential supply in the UK. Brexit-related uncertainties are causing some companies to delay decisions about building capacity and entering new markets. And the UK's eventual new trading arrangements will require a period of reallocation as some sectors of the economy expand and others contract. Moreover, prolonged low investment will restrain growth in the capital stock and increases in productivity. Indeed, if the MPC's current forecast comes to pass, the level of investment in 2020 is expected to be 20 percentage points below the level which the MPC had projected just before the referendum.
In your opening remarks, Governor, that Brexit is beginning to affect.
If the economy follows a path broadly consistent with the August central projection, then monetary policy could need to be tightened by a somewhat greater extent over the forecast period than the path implied by the yield curve underlying those projections. Any increases in bank rate would be expected to be at a gradual pace and to a limited extent.
Please wait for the mics to come around, and as usual, just one each first time round if you could. Ed and Gemma first up, please.